Business investment has been pretty weak in 2018. Again, this was in line with the bank's expectations. We didn't expect it to be all that robust. One of the reasons for that is obviously political. There's too much uncertainty. So we ran an investment survey in the agency network through September, October this year. And one of the things that it pointed to was that companies were willing to spend and invest where there were no regrets, or whether it was a fast payback, or if it was taking cost out of the operation. But anything that was ambitious was going on hold pending the outcome of greater clarity around the Brexit situation. So we've seen a relatively subdued investment story as we've moved through the economy. Access to credit, and relationships with the banks, relatively well weathered through Brexit. So one of the things that the bank published earlier last week was the stress testing figures that came out from the bank, and the stress testing figures pointed to a relatively robust banking sector that was well capitalised and could deal with any shocks to the system that could come as a result of a disorderly or political instability over the next couple of quarters. So one of the things that we weren't concerned about in the Bank of England was so much was the financial system. It was how prepared the rest of the economy was for all of this relative to the banks. We haven't seen the banks respond to any of the sort of the Brexit news story very much in terms of rates and tightening lending criteria, certainly not in the housing market, certainly not in the household space, more in the corporate lending space, but that's normally specific to certain channels. So risk appetite in things like construction and retail have changed slightly for obvious reasons, and less so in other sectors. Unemployment has continued to fall, so we have almost record low levels of unemployment in the UK economy. We currently have something like 860,000 job vacancies in the UK economy and growing. There's a bit of a skills mismatch in the economy, and I regularly hear about labour market tightness and how hard it is for businesses to recruit at the moment, and that in turn is leading to some pressure on pay growth. The banks talked endlessly about productivity and productivity weakness in the UK economy. If we look back at the period 98 to sort of 2008, we see the UK economy's productivity line growing very much in line with the other countries in that sort of pack. But ever since the financial crisis, the UK economy's productivity line has behaved differently to the rest of the countries in this pack. The United States and Canada have continued to show relatively robust growth in productivity, as have some of the other engine countries in Europe, but very much UK and Italy and France, if you look at the bottom three lines, struggling with regard to sort of productivity growth and improving in that space. And that's, I guess, one of the reasons also why we see a slower speed economy at the moment. When we're employing all these people, so we're growing in terms of the amount of people in work, but the productivity of those people in work isn't enabling us to see elevated levels of growth in the economy, because we've got this productivity puzzle going on in the economy.